Pfizer stock ticker PFE is currently trading at $35.53 per share and has been on a downward trend for over a year now. We can see over the past year down about 33.5% and year to date down almost 31%. Now the good news about this is it gives them a very nice starting dividend yield sitting at 4.62%. And if we dig into the dividend stats just a little bit more, you can see again nice starting dividend yield, nice low payout ratio, decent history of dividend growth, and a decent 5-year dividend growth rate of 5.32%. And keep in mind, this is a company that during the pandemic generated over $100 billion in revenues. And in fact, if we jump over to our income statement, you'll see just how drastic that change in their revenue was during the pandemic. You can see in December of 2020, their income was sitting at around $41 billion, but the next year it jumped up to $81 billion. And as of December of 2022, they hit over $100 billion. And of course, a lot of this was from the sales during the pandemic. Now, like we know, the sales from the pandemic are starting to slow, which is a huge potential problem from Pfizer. If we jump back over to that article we were just looking at, we can see the company has spent over $70 billion on mergers and acquisitions and promised $25 billion of new product revenues, but other key drugs are losing patent protection. So while the dividend stats do look nice for this company, they have seen some massive revenue growth over the past couple of years. The question is it worth investing in this company for the dividend alone? Because the growth rate projections are starting to look pretty low, and as we can see, the historical performance from this company has not been very good. So in this video, we need to jump into my stock valuation spreadsheet to see if we can find the intrinsic value of Pfizer and decide if it's a stock we should consider buying or selling. We'll be looking at 4 different valuation models like always. So if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in PFE and hit enter, and you can see all of this data will automatically load in. Now, like we already pointed out, the 365-day change chart is down dramatically. We've already talked about that dividend yield, 4.62%, which means they have a dividend payout of $1.64. Nice low payout ratio, but the 20, 50, and 200-day moving averages all down quite a bit. Analysts currently have a target price of $46.23. Institutional ownership decent at around 70%, and a pretty low beta sitting at 0.61. So you shouldn't see very much volatility with this company. But let's go ahead and jump into our first valuation model, and that is going to be Graham's valuation. Here's the formula he laid out for us to calculate intrinsic value. So the first thing we need is our earnings per share, which we're looking at the trailing 12 months for this company, which is sitting at 5.08. We're then going to apply our growth rate projection. And if you look at most analyst projections, they really don't have any growth projected for this company. In some cases, you'll even see negative growth rate projections. So that's definitely not something you want to see. We then multiply that by 4.4, which is the average yield on AAA corporate bonds, and divide by Y. Now, Y is the current yield on AAA corporate bonds. And at the time of this video, it's actually the highest I've seen it in the past couple of years, sitting at 4.88, which is definitely going to drive down this valuation quite a bit. You can see it gave us an intrinsic value of $32.06. So yes, that current yield on AAA corporate bonds definitely driving down this valuation quite a bit. Let's go ahead and jump over to our next valuation, which is the discounted cash flow analysis. And this was actually a pretty unique DCF model, and I'll show you why here in just a second. But again, we want to project how much future free cash flow the company is going to produce. So we need to project a growth rate to those future free cash flows. So to do this, I plugged in the historical free cash flow so we can see our year-over-year free cash flow growth rates. Now, like the revenues, you can see there was a big jump up in 2021 and 2022 from where the company had been previously. So the average growth rate is showing pretty high because of this huge jump up right here. Now you can see I'm actually projecting a free cash flow growth rate of -1% for the next 4 years, but after that I do expect it to level out and be closer to 0. So as of the year 2026, I'm projecting no free cash flow growth. I'm also projecting 0 to the terminal value. So once I've done that, I take the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, and subtract out the total debt to get that equity value. I then divide by the shares outstanding, which it looks like it has increased a little bit over the past couple of years, but we come to a discounted cash flow price per share of $58.76, which means they are producing a lot of free cash flow. So even with a -1% free cash flow growth rate for the next 4 years and a 0% growth rate moving forward, it still looks like the DCF model comes out pretty strong. That's definitely a concern whenever you see a negative growth rate. That's definitely not something you want to see. Now, the next valuation model we typically look at is the multiples valuation, but after going through this one, I really didn't feel like it provided a fair valuation for Pfizer in this scenario. So let's go ahead and keep moving forward and look at our dividend discount model. And this is a great way to value dividend paying companies because it values them based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see I've plugged in the quarterly dividend payouts right here. So we can see those year-over-year dividend increases right here. And they've had 5.56%, 8%, 2.56%, and 2.5%. So you can see that dividend growth rate has slowed just a little bit over the last couple of years, which is to be expected if the free cash flow is expected to slow down as well. So moving forward, I'm projecting a 3% dividend growth rate, discount rate of 8.5%, which gives them a dividend discount model price per share of $30.71. Now, we do need to point out, yes, that is under the current trading price, but also is that dividend growth rate of 3% sustainable, especially with a negative growth rate projection with the free cash flow for the next couple of years and 0% free cash flow projected after that. Because obviously, if your free cash flow isn't growing, it's really hard to grow dividends. But like I mentioned earlier, if we look at that dividend payout ratio, we can see it's only sitting at about 26%. So that does make me feel comfortable with their ability to continue to increase the amount they pay out in dividends, again, leading to a valuation of $30.71. So when we jump over to our output tab, we can see our three valuations that we used: grams at 32, DCF at 58.76, and dividend discount model at 30.71. And when we average those three together, we come to an intrinsic value of $40.51, a little bit higher than that current trading price. With a 20% margin of safety, you could see our acceptable buy price sitting at around $32.41. So it's not quite within our margin of safety. With a 30% margin of safety, our acceptable buy price would be $28.36. So to me, this does look like an example of a company that may be slightly undervalued, but those growth projections are definitely very concerning, and it's enough to make me want to stay away from the company. Yes, they do have a very nice starting dividend yield, pretty good history of dividend growth, and a decent 5-year dividend growth rate with a low payout ratio, but overall, that lack of growth is enough to make me stay away from this company. I'm not interested in it at this time. But there you go, there's a quick analysis on Pfizer. Go ahead and let me know what you think of this company in the comments down below. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.